Hey guys, welcome back to the channel. Today we will be talking about Umedic's lowering share price but improving fundamentals. Now before we begin, guys, we do not own any shares in Umedic, and what we say is purely educational. None of it should be financial advice. Hey guys, if you're interested in building a 6 to 7 figure portfolio using the power of stock investing, head over to the comment section or the description to sign up for our free masterclass so that we share with you exactly how we do it. Alright guys, so fun fact is that this company, if you search up the stock price on Google, you actually cannot find it. You have to go to another website.
Yeah, this is a KLSC screener.
KLSC screener. Yeah, I think we put the source wrongly, but it's okay. Fine. So you can see like at a high of
90 cents.
You get 90 cents. I would guess it's somewhere in April, May. It went all the way down to 60 cents. That's a 33% decline. Quite painful. And then now it's back up to 70 cents level. So that's very interesting. This is a company that has grown 40% every year. But the share price, at least in the past, you can say year, went only from 50 to 70 cents, which is not bad. Not bad.
Okay.
So yeah, so here are some details, right? It started off with IPO of 120 million market cap. Today is 267 million, and it's related to another high flying stock.
Yep.
Which is
UWC. Yeah, which actually have grown more than 10x since its IPO.
It's an amazing.
So
yes, what do they do? Let's begin with that.
Okay, so the business is actually very simple. They distribute medical equipment in Malaysia. So about 80% of their revenue contribution actually comes from this segment. And then the remaining 20% actually they make this thing called the medical consumables, which is like your pre-filled humidifier. So what is that? Is the picture over here. Yeah, you know, like those I'll say like when you're as a patient, right, you got those drippers. Yeah. So that is your humidifier. And fun fact is that they have about 30 to 40% market share in the distribution industry and the medical equipment in Malaysia. And they got over 90% of market share in the manufacturing business. But the industry is actually very small. Yeah, there's not a huge market growth or growth potential in that particular segment. But the distribution space is still fairly okay.
But I would imagine it's a much lower margin.
No, actually for the manufacturing one, it's a much higher margin.
Wow. Sorry, for distribution.
Yeah, definitely. Yeah, 100%. Yeah, for manufacturing, it's quite high because it only requires plastic and water. But then the reason why their margin for this particular segment is pretty it's actually quite low. On paper it looks low because of the distribution depreciation of their property.
I see.
PPE. So that's
right. Okay, so this is where their businesses are. So they're mainly in Semenanjung or Peninsular Malaysia. And then they have one in each of the eastern states, right?
Yes. So yeah, nothing much. They are just in local in Malaysia.
Okay. But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description. Right, so now we look at the numbers, right? It's quite impressive actually. You can see on the left side, revenue has grown by a lot. This is about roughly 40% every year. And Q1, I'm looking at it like just eyeballing it, it's due to drop, right? It looks like it's going to drop. So we'll see. And we look at the gross profit, same story, profit before tax, same story as well. Now, this is quite typical of companies that are about to list. Somehow, I used to work for a company that got listed, and I can share with you there's a strong incentive for a lot of businesses that go into IPO to insist or to try their best to boost the profits up by whatever means necessary, obviously not in an illegal way, but they'll try to push it up because then
on paper it looks good.
That plus also because of that, they might command a higher valuation. Or even if they have the valuations fixed by the investment bankers already, a higher profit means, even at a fixed, let's say PE ratio of 15, if you increase your profits, then your valuation when it comes out in the market cap is a lot higher. So I wouldn't be surprised, right, that Q1 for 2023 will actually be lower.
Yes.
Because they probably had to engineer certain things to happen to make it look a little bit better. So it's one pro tip for you guys. Whenever you look at IPO companies, they tend to do things not necessarily illegal that boost the profits, at least at the beginning.
Yep. That's a good point.
So margins have been quite consistent, which is what I like, especially on the gross profit margin side.
Yeah, I think one of the reasons is because they got a large market share in the place where they are operating in. Their distribution business, I mean, in the previous slide, I mentioned it's about 30 to 40% market share. They have it. That's why they can command such a high gross profit margin. But the thing that is impressive to me is that their profit before tax margin is actually improving. So which means they are actually kind of controlling their costs pretty well. They're managing it very well.
Interesting.
Yeah. And yes, they are in the net cash position, which is awesome. But of course, the cash actually comes from their IPO proceeds.
Right.
So, but the good thing is that their loans are actually going to almost close to zero actually. So now they only have like 5 million-ish, but then their cash is about 22 million. Yeah. So that's a huge cash pile in their balance sheet. Now, cash flow wise, a little bit choppy operating cash flow. So you can see like there are days they are actually making negative, but the one thing that actually captures my attention was their maintenance capex, or actually their operating expenses. Right, you can see that there's actually a steep up increase. Yeah. As this is actually especially in their administrative expenses. So maybe they need to retain their talents. So that's why they need to pay a lot, or maybe because they simply just grow their team a lot. Which
I mean, if they're in distribution, you imagine that sales is a very important part.
Yes, correct. Yep.
So they need a strong sales force.
Yeah, and not much of growth capex. They didn't. I think they already have like set a certain goal that they're going to expand this much already. So there's nothing much over there. They didn't really distribute any dividends in the recent years.
So I think that is one thing to look out for. Like, I like companies that are small. I also like companies that have growth potential. And number two is that they don't pay any dividend, or they're very little. So that what happens is that if they start growing in the future and then they start paying more dividends, the valuations will start to creep up because more people want to come in, more people perceive it as safer. So they start jacking up the valuations.
So now Umedic is like in a phase of like a growth phase instead of maturity. So they're still an infant.
So
net cash. Oh, actually, these I should put valuation instead of net cash. But they are trading they're commanding at a quite high valuation, about 30 times price to earnings before tax ratio. And if you look at their growth, right, in terms of revenue, just now you mentioned they are actually growing at a 40% per year.
Yeah,
in the top line.
But I mean, I think 2023 they're not going to achieve that. Unlikely.
Unlikely.
Yeah, but
maybe, most likely it will drop. Yeah.
Alright guys, enjoying the video so far? If the answer is yes, remember, like, comment, subscribe. And as far as comments go, if you don't like the video, do let us know as well. We always take all sorts of feedback, as long as they're constructive. Okay, so just as a takeaway, right? I think this is a company that is in the right industry.
Yes.
Right? Healthcare is always great. It's just that I don't know whether 40% is sustainable. 40% is approaching like Tesla level kind of growth.
Yeah.
Now, before I move on to what I like about the company, right? I think it's worth mentioning a little bit about maintenance capex and this concept of maintenance capex. So maybe you want to share your thoughts a little bit on that.
So basically your maintenance capex is whatever expenses that you need to spend in order to keep that operation up and running.
Yes.
Yeah, that one is like you have to spend it no matter what, no matter what the environment is happening. But for growth capex, you can actually stop if, let's say, assuming that you really need the cash, you don't really have the capital already, you can actually stop your product, stop expanding.
Right.
You can keep some cash, but maintenance, anyhow, you have to spend it.
Right.
So that is just to briefly explain between growth capex and maintenance capex. Right. And just now I showed you their maintenance capex on a steep increase. It's a little bit more worrisome, but I think it's also okay for them to have such a high increase because they are expanding their business. Yeah, they need more manpower to actually drive their sales, their top line, in order to sustain those 40% revenue growth, right? So it makes sense, but we will see whether can they actually deliver. the 40% revenue growth year on year.
Fair enough. Now, anything you want to add on this
No,
takeaway?
actually it's pretty much straightforward.
So one thing I like about this business, just looking at this, is the fact that the gross profits margins are quite controllable, right? They're not like before everything unraveled, Serba dynamic, right? In the past, it was very nice and flat. This one, it's still a bit choppy, but you can see, it's within a very reasonable range. That's always a sign that I like that, the company is, more specifically, the management is very good with managing costs, depending on how the business ebb and flow. But like I said, we will see. Who knows in the future what it will look like. Now, guys, if you really like the way we look at things and analyze things, and if you want to figure out how you can find like all these companies, we have this thing called FIRL Pro where we go in depth into a lot of these stocks. We have a team of analysts producing very short 5 to 10 minutes reports essentially that you can read it before you finish a cup of coffee, for you to decide or help you speed up your decision making process when it comes to investing in
and
stocks.
before that, that is our performance.
So far this is from I think August to November. So far, out of the 9 stocks that we put into the portfolio, 7 has been doing well, 1 is neither here nor there, and then 1 is not doing too well. So this is the kind of things that we do right in this program. And if you want to get a sample, get a taste of what it looks like, we have a link in the comment and the description where you can essentially sign up for free and see a sample. But if you have more questions, feel free to just send us an email, or you can just DM us
on social media.
You join our Telegram group and all that. So yeah, guys, anything else you want to add?
Nope.
All right, guys, hope you enjoyed the video as usual. Continue to support us by liking, comment, and subscribe. Join us on our other social media channels, and we will see you again soon.